When a manufacturer decides to expand market reach, whether into a neighboring state or international territory, they run into an immediate structural roadblock. Entering a new market typically requires constructing proprietary retail facilities. That means signing commercial leases, hiring regional staff, and sinking massive amounts of capital into unproven physical infrastructure. To bypass this massive capital expenditure, a company can collaborate with an existing local entity. By sending inventory to an established operator, the creator can leverage that partner's local market knowledge to sell goods on their behalf. This operational mechanism is called a consignment. A wholesaler or manufacturer ships their goods directly to an agent, and that agent sells the inventory on a commission basis. Expanding successfully requires a specific legal structure that allows a business to test a new territory without first committing the capital needed for permanent facilities. This minimalist network graph visualizes the central thesis of the consignment model. It strictly unbundles the physical movement of inventory from the transfer of legal title. In this model, the goods are physically transported and stored thousands of miles away from their creator. Despite that physical distance, the legal document granting ownership over those goods remains locked firmly in the creator's hands. This structure breaks the logic of standard consumer transactions, where physical possession and legal ownership move to the receiver at the exact same time. To understand exactly how consignment manages these two concepts, we have to isolate the mechanics and analyze them side by side against a standard commercial sale. Grasping this decoupling is vital. If a warehouse holding the goods burns to the ground, the physical location of the ashes matters far less than the location of the legal title in determining who absorbs the financial loss. Here is a split-screen, dual-track system tracking inventory under different legal frameworks. The top track represents a standard sale, and the bottom track represents a consignment. On the top track, we have the traditional actors, a seller sending goods to a buyer. On the bottom track, the consignment model defines its actors differently. The party sending the goods is the principal, or consignor. The receiving party is the agent, or consignee. A standard buyer-seller relationship terminates permanently when payment is made and goods change hands. By contrast, the principal-agent relationship operates as an unbroken, continuous partnership. It remains active until formally terminated. When the principal ships inventory down this continuous line, accountants label the initial movement as an outward consignment. From the perspective of the agent receiving the boxes at the warehouse, the exact same shipment is logged on their books as an inward consignment. The structural label placed on the receiving node, buyer versus agent, dictates the lifespan and the financial liability of the resulting business relationship. The practical differences between these labels become visible at the exact moment of delivery. In a standard sale, both the legal right to claim the asset and the liability for its destruction pass to the receiver instantly. The exact moment of delivery looks starkly different during a consignment transaction. While physical possession transfers entirely to the consignee, the legal ownership status does not move an inch. Because of this strict lock, the consignor continues to bear the complete risk of loss or damage. If a flood ruins the inventory while it sits in the distant warehouse, the principal absorbs the blow, not the agent. Consequently, the consignee does not owe the principal money simply for receiving the shipment. They do not become a debtor, and they cannot claim that newly arrived inventory as an asset on their own balance sheet. Physical control of a warehouse is functionally irrelevant to determining financial liability. The balance sheet only recognizes the entity holding the invisible legal title. We can now look past the flow of physical boxes and map out the flow of capital and operational expenses. A standard sale operates against a fixed price. Once the buyer pays that price, they alone bear any downstream costs required to store, market, or resell the items. In a consignment structure, the consignee pays absolutely nothing up front. They are operating the local retail footprint entirely on the principal's account. If the agent incurs expenses to store, secure, or advertise the goods locally, they are legally entitled to expense reimbursement. Those costs must be paid back by the principal. The agent turns a profit by extracting a specific pre-arranged percentage of the final sale to an end user. They act strictly as a conduit for the principal's revenue, earning their commission for making the connection, rather than acting as a primary purchaser trying to mark up a wholesale price. Under this model, the receiving entity functions as a risk-free service provider rather than an upfront purchaser of inventory. This legal arrangement requires specific administrative tools to handle the end of the inventory lifecycle, especially when goods fail to attract local buyers. In a completed standard sale, a buyer owes the seller zero ongoing communication regarding whether the inventory actually sold or is gathering dust. A principal-agent relationship mandates rigorous ongoing reporting to bridge the geographical gap. The primary mechanism for this is a required document called the account sales. The agent must periodically submit the account sales to update the principal on current inventory levels, accumulated expenses, and the total value of finalized sales. If the data shows the goods are failing to sell, the two tracks diverge again. A standard buyer cannot simply hand back goods to the seller just because they made a poor purchasing decision. The consignment model offers a unique structural recourse. The agent has an absolute right to return unsold stock. If the consignee feels the local market has cooled, they can ship the goods back at any time. Returning this stock triggers no financial penalty for the consignee, precisely because they never owned the goods in the first place. Mandatory account sales reporting and flexible return rights act as structural safety valves. They guarantee the local agent never absorbs the cost of a broader market failure. Pulling back to view the entire supply chain, choosing a consignment model over a standard sale is a calculation of strategic trade-offs. For the consignor, the benefit is extreme operational leverage. They achieve market penetration and utilize seasoned local expertise without spending a single dime on leasing retail space. In exchange for that leverage, the consignor accepts a specific set of burdens. They retain total liability for risk, legal ownership, and all localized expense reimbursements until an end user finally makes a purchase. For the consignee, the benefit is equally calculated. They gain immediate access to revenue-generating inventory, allowing them to earn a profit without taking on asset risk or damaging their existing debt profile. Consignment is distinct from a delayed or deferred commercial sale. It operates on entirely separate legal principles regarding ownership and possession. This structure separates physical operations from financial liability, allowing two entities to operate in the same market while maintaining distinct levels of risk exposure.